What are depository receipts? Before we dive into the regulations, let's start with a quick overview. Depository receipts are financial instruments representing shares of a foreign company, which can be traded on stock exchanges outside the company's home country. Depository receipts allow investors to invest in foreign companies without dealing directly in the foreign markets. For example, a US investor could invest in an Indian company's American depository receipts, which are traded on a US stock exchange, representing shares of the Indian company. Similarly, under the IFSCA regulations, companies can issue depository receipts in IFSCs, giving global investors access to their shares. Eligibility for listing of depository receipts. Let's move on to the eligibility criteria. Under Part A of Chapter VIII, an issuer that is incorporated outside of an IFSC can list its depository receipts provided it meets the following conditions. Authorization. The issuer must be authorized to issue depository receipts under the applicable laws of its home jurisdiction. Underlying securities. The underlying securities represented by the depository receipts must be in dematerialized form, fully paid up, and free from any encumbrances. These conditions ensure that only securities that are legally allowed to be traded and are fully paid up can be listed as depository receipts in the IFSC. Public offer of depository receipts. Offer size, filing and disclosures. Now, let's move on to Part B. Public offer of depository receipts. Under these regulations, the offer size must be no less than USD 700,000 or another amount specified by the IFSCA. For any company planning to list depository receipts through a public offer, the next step is to file a draft offer document. This filing process follows the same rules as filing for an initial public offering under Part A of Chapter VIII. The offer document is crucial for ensuring investor transparency. It must include all material disclosures that are true, correct, and adequate to enable investors to make informed decisions. Here are the key disclosures that must be included. Offer document summary. A brief overview of the offer details, risk factors, all potential risks associated with the depository receipts, and underlying securities. Capital structure, including details of shareholders holding 5% or more of the pre-issue paid-up capital. Particulars of the issue, including the objects of the issue, requirements of funds and deployment of funds. Disclosures related to underlying securities. Information about the underlying securities and the depository receipts. Rights of the depository receipts holders such as dividend and voting rights. And information related to managing the depository receipts. Additionally, the offer document must provide financial statements of the issuer for the last 3 years or for the period since incorporation if the issuer has been in existence for less than 3 years. The financials must comply with IFRS, US GAAP, or India AS, or be reconciled with IFRS if prepared under other accounting standards. Pricing, offer period, and allotment. Moving on to pricing, the issuer has flexibility in determining the price of the depository receipts. The price can be set through either a fixed price mechanism or through a book building process in consultation with the lead manager. Once the price is set, the public offer of depository receipts must be kept open for at least 1 working day and not more than 10 working days. After the offer closes, the issuer and the lead manager are responsible for ensuring that the depository receipts are allotted and that payments and refunds are completed within 5 working days from the date of closure of the issue. All of these steps must be carefully coordinated to ensure smooth and timely completion of the public offer. Listing and minimum subscription requirements. Once the depository receipts are allotted, the next step is listing. The issuer must list the depository receipts on a recognized stock exchange in the IFSC within the time frame specified by the exchange. However, before listing, the minimum subscription requirement must be met. The issue will only be allowed to proceed if the subscription reaches at least $700,000 or any other amount specified by the IFSCA. Secondary listing without public offer. Under Part C of Chapter VIII, companies that have already listed their depository receipts in a jurisdiction outside the IFSC can apply for a secondary listing in an IFSC without conducting a public offer. The issuer must file a listing application in the form and manner specified by the recognized stock exchange, where it wishes to list its depository receipts. This process allows companies to tap into the liquidity and investor base of an IFSC without going through the public offering process again. Secondary listings provide companies with greater access to international investors and enhanced liquidity, while ensuring that the regulatory requirements of both jurisdictions are met.